Hello dear little traders, today we will deep dive into one of the most popular indicators in the world. It's called MACD, abbreviation for Moving Average, Convergence and Divergence. We will understand its basics by using our backtester software, test its performance objectively with every aspect and find out the most profitable way to use it. If we use MACD on your trades but cannot make the profits that you were expecting, then we highly recommend you watch this video because you had never studied MACD with this level of detail before. In this video, we will backtest so many different MACD strategies with our softwares. It doesn't make sense to share all of them, but as usual, the backtester of the most profitable MACD strategy will be open to your use completely for free. You can find the link to that backtester in the description of this video. You can use it completely for free to test this strategy on your favorite coin and on your favorite time frame. As a result, you will be able to find the most profitable indicator settings and risk reward ratio for you. But first, please make sure you watch the video and make sure you understand how you should use it. You can also use this backtester as a signal generator for your live trades. Let's give it a start. MACD is an abbreviation for Moving Average, Convergence, Divergence. It's a trend following momentum indicator and it shows the relationship between two exponential moving averages. But what does that mean, right? That explanation does not help us decide how to use it. First, let's understand how MACD works, what is the mathematical model behind it, and after that, we will be able to use this popular indicator with its all potential. MACD follows the trends. It's a lagging indicator, which means when it gives you a signal, the trend has already started. It does not predict the trend beforehand but informs us when the trend starts. When we open MACD, we can see one blue and one orange moving lines, green and red histograms, and a zero line which is located at the center of the indicator. Blue line is called the MACD line. This line is created by calculating the delta, the difference between long-term and short-term moving averages. When you open MACD, the default setting for short-term calculations come with 12 bars, which means it takes price data from the last 12 candles to calculate short-term moving average. And the long-term moving average comes with 26 bars as default. As you know, moving averages are very important indicators for trend direction defining. If price is above the long-term or medium-term moving average, then we can say that there is an uptrend. And if the price is below the long-term or medium-term moving average, then we can say that there is a downtrend in the market. Meanwhile, crossover or cross-under conditions between short-term moving average line and long-term moving average line gives us very important information about trend direction changes as well. For example, if short-term moving average crosses over the long-term moving average, this tells us there is a high probability that trend may be changing its direction from downtrend to uptrend. Similarly, if short-term moving averages crosses under the long-term moving average, then this tells us there is a high probability that trend may be changing its direction from uptrend to downtrend. MACD uses the same principle, but it does that with a much more precise data. As a result, MACD can show us trend reversals before moving average crossovers or cross-unders. It catches the trend direction changes earlier than the moving averages. Let's prove it with a live example. On the chart, you can both see MACD and two moving averages. Moving averages are set to 12 and 26 just like MACD. However, when we check the crossover or cross-under signals, we can easily see that MACD crossover or cross-unders are coming earlier than the moving averages crossover or cross-under signals. What is the reason for that? They are using the same moving average data, right? The reason behind that better precision is the signal line, the orange line that you can see on MACD. The signal line is created by taking a 9-period moving average of the MACD, And most of the sources that you will see or read will tell you to use MACD something like this. If blue MACD line crosses over signal line, then it's a buy signal. If blue line crosses below the signal line, it's a sell signal. We coded a backtester to see the performance of this strategy. Now let's open it and test the strategy and see the results. Today, we will test Ripple 1 hour chart's 1 year performance. Okay, since we are on a 1 hour chart, we picked our stop loss as 4%, which is around 2 ATR level. We will also start our test with 1 to 2 risk and reward ratio. Since it's a very dynamic indicator, very high risk and reward ratios like 1 to 5 will not be very successful. Let's check our profitability. In the last 1 year, on Ripple 1 hour chart, this strategy opened and closed 746 positions. Consider that you started a robot on this strategy and it was trading for you for the last 1 year. Then 33% of these positions would have hit its targeted profit levels. And your net profit would be around 63% for a year. 63% profit in a year is a very good number, so we can call this strategy as a profitable one. But you will see that far more successful MACD strategies exist. What if we change the short term to 5 and long term to 35 and signal period as 5? Let's do it. 35 and signal period is 5. Okay, although our success rate did not change, we are achieving a far more better net profit result because we increased the number of signals with the same success ratio. Now we opened 1350 positions in a year and made 170% profit. We can say that this new setting didn't change the quality of the buy or sell signals, but it increased the number of position potentials significantly, and at the end of the day, we are making more money. Okay, now we are changing the settings to 12, 26 and 9 in order to be able to back-to-back test this strategy with the other ones. However, you can always optimize your strategy by trying different indicator settings before starting a robot on it. Today we will test a lot of different strategies with different software. If we use different settings on each, it will not give objective comparison results. So we will use the same settings for all of the strategies. But as we mentioned, when you choose your strategy, you may optimize it according to your time frame and coin dynamics and increase your profitability further up. Let's start testing the second MACD strategy, which we call MACD trend reversal. If you remember, we mentioned that if blue and orange lines are above the zero line, then we can assume that there is an uptrend, and if these lines are below the zero line, then we can assume that there is a downtrend. If we are targeting to catch the trend reversals, then we will check zero line as well. If we are trying to catch a downtrend reversal, which means we are expecting the price to stop going down and start going up, then we will check the blue line crossovers only below the zero line. If blue line crosses over the signal line above the zero line, then we will not open a long position because in this strategy's theory, if blue and orange lines are above the zero line, then we are already in an uptrend and we cannot talk about a healthy trend reversal. Similarly, for the short positions, we will wait for the blue line to cross below the orange line only above the zero line. Okay, let's check the results. As you can see, our success rate went up significantly. However, our net profit went down. We are losing money. It is very interesting, isn't it? Let's understand what may be the reason for that. This is the power of using backtester, dear little traders. We can see every little detail here and understand which strategy is best for us. The first issue is the number of positions. As you can see, it went down significantly. Only 457 positions were opened. But if we use a 1 to 2 risk and reward ratio, then this success ratio should be enough to make a nice profit. Just like we explained in the previous MACD strategy, we can tell that most of the positions were closed by the opposite direction signals before they hit the desired take profit levels. For example, we were waiting our position to be closed with an 8% profit, but it was closed with the opposite direction signal and gave us only 3 or 4% profit. Then this success rate will not be enough to make profit. We believe now we are aligned that the MACD trend reversal strategy is not something we can use on our trades. At least it cannot be used with standard settings and an ATR based average risk and reward ratio. If you have already watched our Bollinger Band and RSI video, then you may remember that trying to catch a trend reversal with only one indicator is a very hard task for an average trader. So we should be targeting something else. Then let's go to our third MACD strategy, which is a MACD trend follow-up strategy. We opened our new backtester and we are ready to start. On this strategy, we will not try to catch a trend reversal, but try to catch the small waves with the same direction of an already started big trend. How can we do that? We can do that again by looking at our zero line. We know that if the blue and orange lines are above the zero line, then there is an uptrend. And if blue and orange lines are below the zero line, then we are in a downtrend. So, in order to open a long position, we will wait for the blue line to cross over the orange line only when the blue and orange lines are already above the zero line. Okay, if they are above the zero line, then we know that there is an uptrend and we will try to catch a small wave by waiting for a crossover above zero line. And similarly, if we are below the zero line, then we will only look for cross unders to open a short position. This is the logic of the strategy. Now let's check the results. Surprised, aren't you? The strategy opened only 286 positions in a year. The success rate is around 38% and the net profit is a magnificent 239%. This means most of the successful trades closed by hitting the desired take profit levels. They were not interrupted by opposite direction signals. We are pretty sure that you have never seen MACD used like this before. But this is the result and this is the proof. And this is the difference that we are trying to make as Doolittle Trader team. We are trying to contribute to your trading success by showing you different aspects with mathematically proven information. Okay, let's go back to our topic and see how we can improve our MACD strategy. Although it seems profitable, we wouldn't use MACD on its own. Why? Because MACD only works on a trending market. On the ranging market, it will give a very high number of false signals and its success rate will drop significantly. So, if we can find a way to confirm if the market is trending or ranging with a different indicator, and if we can combine these two indicators together, then we can assume the results will be much better. MACD is mostly used with exponential moving average. We already mentioned that exponential moving averages are very strong trend direction indicators, and we will use this information and combine it with our previous MACD strategy. Let's recap what we tested so far. First, we tested a strategy which opens positions to all of the MACD crossover and cross unders. Secondly, we tried to catch the trend reversals with MACD. And lastly, we tried to catch the small waves in line with the main trend direction. Now we will add exponential moving average to all of these strategies and compare the results objectively. We will use a 100 bar exponential moving average as our long-term trend direction indicator. If the price is above it, then we will consider that there is a long-term uptrend, and if the price is below 100 EMA, then we will consider that there is a downtrend. First, we will check all MACD signals without any filter. If a MACD crossover happens when the price is above 100 EMA, then it will open a long position, and if the cross under is happening when the price is below 100 EMA, then it will open a short position. In the next three strategies, when the price is above 100 EMA, only long positions will be open, and if the price is below 100 EMA, then only short positions will be open. We will not go into the details of the next three MACD and EMA combined strategies, but we will show you the results instead. Let's check the first one. In the first strategy, MACD zero line is completely disregarded. All MACD signals got a buy signal as long as price is above 100 EMA, and all cross-unders got a sell signal as long as the price is below 100 EMA. Okay, as you can see, within a year, it caught 351 positions, 41% success rate, and an incredible 408% net profit. You started a robot with a $1,000 capital, and now you have $5,000 in your account. Combining two compatible indicators together can change your overall success this much. And this is the power of knowledge. That is why we always say knowledge is money. By the way, for the time being, we are not taking commissions into account since they are negligible. We are taking about 8% profit per position and giving 0.07% commission, which is not important at all. Let's go to the next MACD strategy, which is MACD trend reversal plus EMA. If we are trying to catch a downtrend reversal, then we will check the blue line crossovers only below zero line and only when the price is above 100 EMA where the main trend is upwards. If blue line crosses over the signal line above zero line, or if the price is below 100 EMA, we will not open a long position. Similarly, for the short positions, we will wait for the blue line to cross below the orange line only above the zero line, and we will open short positions only if the price is below 100 EMA. The result is not satisfactory as expected. The strategy was not satisfactory without EMA either. EMA increased the success. Now we are making money instead of making loss, but net profit is not comparable to the first strategy. As we mentioned many times, trying to catch the trend reversals is not an easy task. We would not use this strategy. And the last strategy where we will test the MACD and EMA combination is MACD trend follow-up plus EMA strategy. This strategy was by far the best strategy when MACD was used on its own. Let's check what it will do with EMA. As you can see on the screen, the success rate is almost 45%. This is a good success rate. Yearly net profit is 378% and the number of positions is 255. If the number of positions were the same, this strategy would give far more higher profit than the first one that we saw 400% profit. However, if you define the trend direction by using EMA, you can use all of the crossovers and cross-unders of MACD as buy and sell signals as long as they are in line with the trend direction. As you can see, the highest success rate that we could achieve so far was with the combination of MACD and EMA and with trend follow-up strategy. Let's see if our last strategy can perform better. We opened the stochastic on the screen. Let's first understand which strategy we will test. When stochastic lines go below 20 line, it is considered that there is an oversold condition and we can expect a trend reversal from here. Similarly, when the stochastic lines go above 80 line, then it is considered that there is an overbought condition and we can expect a trend reversal from here. If you already have watched our Bollinger Band video, you should know how we are using oversold and overbought condition threshold lines. It was an out-of-the-box approach, but we already proved you why we are using those thresholds in an unusual way. If you have not watched it yet, we recommend you do. We will test two MACD plus stochastic strategies, and first one is a trend reversal strategy and the last one will be the trend follow-up strategy. Let's start with the first one. As you can see, it will be the trend reversal strategy. When stochastic lines are below 20, we will consider that there is an oversold condition. And if we see a MACD crossover when stochastic is below 20, then we will consider that there will be a trend reversal. Okay. Just like this one, stochastic is below 20 and MACD crossover, you see a buy signal. And the opposite conditions will trigger the sell signals. Now let's check the results. As you can see here, there is no profit. You can see that the strategy, which is explained on YouTube channels very frequently with very high profit claims, is just a sugar coated dream. Okay, let's go to the last strategy that we will test today. It's a MACD plus stochastic trend follow-up. As we explained in our previous videos, we can detect oversold and overbought conditions with our indicators. But we cannot know how long that condition will last. In this strategy, when stochastic crosses under 20 line, we will consider that a powerful movement started in short direction. If we confirm that movement with MACD cross under above 0 line, then we will open a short position to get a small piece of that downtrend. Similarly, the opposite conditions will give us a buy signal. Let's check the results. Unfortunately, there is no profit here either. We can clearly see that we should avoid using MACD and stochastic together. Okay, dear Doolittle traders, we hope we could explain MACD to you with every aspect. We are leaving the most profitable MACD strategies backtester in the description of this video. As you may remember, it was MACD plus EMA trend follow-up strategy. You can add it to your favorites and use it completely for free, either to get signals for your trades or to further improve the strategy by changing the settings and risk and reward ratio. We hope that this video helps you increase your profitability or at least save you from making some mistakes. See you on the next Doolittle Trader video. Take care and bye bye.